So we're kind of in this twilight zone where we're sort of in between mid-cycle and late cycle. You know, the Fed's raising rates, liquidity conditions are tightening, but we have this earnings boom. You know, 24% year-over-year growth for Q1, Q2, which is about to start getting reported, is looking around 21%, Q3 22%. And so we've been able to pull off this win in the market where, you know, the PE ratio in January was way too high. It was 19.5. It's come down to 16.2, and the S&P is down 5%.
Right.
I mean, that, you know, in terms of correcting an expensive market, this is about as good as it gets. And this earnings tailwind nobody else has in the world. You know, globally, earnings have gone from 20%, which is very, very good, 20% growth, to like 12%. And we've gone from basically 12 to 24%. And it's allowing the U.S. market to kind of sit there going sideways while these late cycle pressures are sort of working themselves out. And the rest of the world doesn't have that luxury. You know, Germany's down 10%, China down 20%, emerging markets down 19%. So we're in a very unique spot in the U.S. right now.
So you would be telling people to buy right here, that the market has corrected itself?
I would say that if you're a long-term investor, the S&P just has to sit around and do nothing for the next 6 months. And if earnings continue to grow, which all indications are that they will, we'll be trading at a 15 multiple. You know, what's not to like there? But a lot of it does come down to a year from now, you know, where is the Fed going to be? If the Fed keeps pushing policy to restrictive levels, let's say, and the way I measure that is by looking at the policy rate, Fed funds rate, over and above the so-called natural rate, or R star. If a year or 2 years from now we're at 200-300 basis points above the natural rate and the curve is inverted, and earnings growth by then has slowed back down to trend of 7%, that's not such a great scenario. But if the Fed says, you know, we're going to do 3 or 4 more hikes and call it a day, then that's a pretty favorable conclusion.
So, Jim, you're the Fed watcher here. What will the Fed do?
I think they keep going pretty much quarter point a quarter. So if you keep doing that, then that's 6 moves over the next year and a half. So that would get you up to basically 340 on the funds rate. Now, Fed officials themselves put neutral at 290. So that's modestly restrictive at that point, which would be appropriate. Again, is that enough to throw you into a recession? It would certainly keep the debate going. I mean, I would argue it's probably not quite enough at that point. But I mean, I think for now the data are so strong, despite the worries about trade, that there's certainly no let up at this point from quarter point to quarter from the Fed.
Yeah, and I think, you know, there's a lot of focus on the yield curve, and will it be inverted a year from now? And I think, you know, the shape of the yield curve, whether it's inverted or not, is only one part of the puzzle. The other one is just how high have rates risen above the so-called natural rate. And historically, you've had both at the same time. This time around, you know, the curve is about 100 basis points between 3 months and 10-year. If the Fed hikes 4 more times and we get to a flat curve, or 6 more times to get to an inverted curve, even then we're only very modestly restrictive. And to me, that's not going to be enough. But it does end up to, like, a year from now, we're going to have this conversation, and it's going to be a lot more pressing than it is now.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.